Okay, I think we'll start. We've still got a few people waiting to get in, I think, but we've got a good number that have arrived, so we'll let everybody in as they join. Welcome everybody to our webinar today. It is on the subject of the 2019 SRA Accounts Rules and how to modernise your approach to benefit from the increased flexibility that they offer. My name's Claire Watkins and I am a partner in Buzzacott and I head up the professional practices team. And as Buzzacott, we look after a number of law firms as well as architects and surveyors. That's really where we focus our attention. And with the law firm side of things, it tends to be the smaller firms that we find ourselves working with more. So sort of the ones that are outside the top 100 generally, although not exclusively. And so this webinar today is really focused on them and how we can best help those sorts of firms try and take advantage of the increased flexibility that these, well, I call them new rules, but they've been in for 2 whole years now, so I suppose they're not new anymore, but they still feel a bit new. But we're going to give you some tips as to how you can make the best use of them and make things easier for yourselves. Couple of housekeeping things. We're going to be recording this, so if you want a copy of the recording afterwards, let us know and we'll send that on to you. You can have a bit, do send us questions using the Q&A function. I should just say, typically when we do these things, we don't manage to get through all the questions, I'm afraid. So if we'll try and answer some as we go along, and we've had some in advance as well, which we're weaving into what we're talking about. But if we don't manage to get to your question, leave it with us and we'll come back to you separately. Although that does mean you have to have signed in with your name so we know who's asked the question, not anonymously, but we'll do our best to get to them. A few introductions. Behind the scenes, we've got my marketing team colleagues, Chloe and Joseph, who will be running the production and making sure that the camera switches and everybody's on screen at the right time. If you've joined one of these before, you'll know that Teams is a little bit behind Zoom in terms of technology capability. So when you hear a new voice appear, sadly, the camera doesn't switch to that person very quickly, so there's a bit of a delay. Nothing we can do about it, I'm afraid, but just bear with us. So this is the second in a series of webinars that we're running on the topic of modernising law firms, and this one isn't specifically to do with the SRA Accounts Rules. The first one we did was how to modernise your firm and help that reinforce financial resilience, and the next webinar that we're doing will be in March and we'll send out invitations in due course. We always like it when our clients and colleagues can give us a bit of feedback and let us know what sorts of topics you want us to cover, so do let us know if there are any topics you'd like us to cover in future webinars. Our 2 panelists today, well, in addition to me, I suppose, are my lovely colleagues, Catherine Edwards, who is a senior manager and has been at Buzzacott for over 10 years now. She works on a number of solicitors, accounts and accountants, accounts rules clients, and as well as architects and various other different businesses, but she's very experienced at looking after law firms, and we've been working together for, well, as I say, over 10 years now. And our other speaker is Harriet Farrance, who joined over 8 years ago. Harriet, I could have sworn it was longer ago than that. I don't know what that says about the 2 of us working together. But she also works with a lot of law firms and architects. And so the 2 of them are very experienced at looking after law firms and understanding how they run. So what we did when we sent out the invitation was we sent a survey, a very short survey, just to try and get a few responses from people so we could frame what we're going to talk about and make sure we're hitting the right points. The answers that we got to the survey were what we'd expected, actually, so I thought I might just cover those quickly. One of the questions was, do you prefer the 2019 rules or the 2011 ones? And generally speaking, everybody preferred the 2019 rules. How much of your procedures changed? Well, the answers really were that they've not changed very much, a little bit, but really not very much. Then we asked, have you experienced any difficulties with the new rules? And we got various different responses, but things like not being sure what to do when returning client money to clients if the client won't bank checks. Understanding timings and what the SRA are driving at when they're talking about doing things on time and doing things promptly, and just generally understanding what the SRA is driving at and what the SRA wants you to do, because of course these rules are now much less prescriptive than they used to be, so they're more open to interpretation. Then we asked, what do you find most useful about the new rules? And the responses we got were that they are more flexible, which is what we expected, and it's good that you can fit them to the firm rather than having to tweak the way the firm works to fit to the rules. And then what's most frustrating for people is that there's a lack of guidance in the rules. That less prescriptive approach and leaving it open to interpretation is causing confusion sometimes, and I think firms are scared that if they do something in a particular way, is the SRA going to disagree with that? A common theme that also came through is that it's quite often not the rules that are the problem, but it's the fee earners who are the problem. I think some of those comments may have been made by account managers, finance managers that we've been talking to. So for all the fee earners who are watching, I'm afraid to say sometimes you seem to be the problem, but we'll try and help through that today. So today's session is in 3 bits. There's a bit of background, just explaining what we've seen over the last couple of years. Then we're going to look at a few horror stories where, really quite major breaches of the rules have occurred. That's since the 2019 rules have come in, and a few from before. And then the third part will be talking about suggestions for how to best adapt your procedures so that you can create flexibility for yourselves, but also adhere to the rules. So we'll transfer over to my colleague Catherine, and before we get into the detail of all that, Catherine's just going to set the scene for us and share some observations from the last couple of years, because of course the rules came in November 2019, so it's been a full 2 years that they've been in, and Catherine's just going to go through a few observations that we have on those. So I'll pass over to Catherine.
Thanks, Claire. Yeah, so as you know, obviously the rules were introduced over 2 years ago now, so we thought it was the perfect time to reflect on what we've learned so far and the changes or lack of changes that we've seen being implemented. So as you know, the rules are shorter, simpler, less prescriptive. They place greater trust in your professional judgment, which reduces the regulatory burden, but also provides you with greater flexibility. The aim was to allow solicitors to be more agile and adaptable in how they work day to day, as opposed to a one-size-fits-all approach. Over the years, as the changes have been implemented by the SRA, it's resulted in a significant reduction in the number of qualified reports received by the SRA. The aim of that was to try and focus the SRA's approach and take a more targeted outcome kind of based approach in really identifying the firms that require investigation. Back in 2012, I found some statistics, more than 50% of reports were qualified, but less than 1% of those were actually investigated by the SRA. Obviously, ultimately, the SRA is there to protect consumers, and they have the power to close a firm down if required in order to protect client money. So them receiving thousands of reports wasn't particularly helpful. Nowadays, they receive very, very few qualified reports, and as a result, they're able to then investigate those firms and really get to the bottom of where there's actual risk to client money, and therefore protect consumers by doing that. Also, I mean, from our experience, we found that firms sit up and listen more if they receive a qualified report now. Back in the day, all of the reports used to be qualified, so it wasn't taken as seriously, I suppose. But now, if you receive a qualified report, it generally kind of indicates that there's a control weakness there that needs to be rectified. Despite all of the changes that have been introduced by the SRA, in our experience, most firms have chosen to stick to what they know and continue to base their procedures on the 2011 rules. So that sort of posed the question to us, why are law firms reluctant to modernise their approach? And one of the most common responses that we've had is that the rules are just too vague. In particular, some coffers and bookkeepers have mentioned to us that it's easier to whip their fee earners into shape if you're able to quote a specific rule, and they mean a specific rule set by the SRA as opposed to an internally set rule. So yeah, the most common answer that we get when we ask firms for their updated policies and procedures is that they don't have them. They're just sticking to the 2011 rules. Obviously, applying many of the kind of 2011 rules, that will no doubt lead to protection of client money, but there are some new requirements that could possibly be missed if you're just simply taking that approach. So just to give a few examples of some of the changes that were introduced in 2019. So with disbursements, you can no longer transfer money to office account or business account. I tend to still use the terminology office account, even though I know it's not explicitly mentioned in the 2019 rules. Yeah, so you can got confused now. Once a disbursement has been billed, it has to be treated as office money now, whether or not it's been incurred. So that was one of the changes. Another change is that bank reconciliations must now be reviewed and signed by a coffer. So actually physically signing it was a new requirement. Bank reconciliations also now required for clients' own accounts, as well as all other client bank accounts. Those are kind of the key differences. There was a few other sort of differences as well in terms of time frame definition. So the word promptly is used now instead of explicitly mentioning a specific time frame. Suspense accounts aren't mentioned in the new rules. And there's a slight difference on interest as well. So it's now clearer in the 2019 rules that the SRA intends firms to put arrangements to clients in writing in such a way that it gives clients the ability to give informed consent. So those are the main changes. Obviously, going forwards with new solicitors and that type of thing, they're going to be taught the 2019 rules. So just taking the approach of we're going to stick to adopting the 2011 rules, that's not going to work long time, and the 2011 rules will kind of become diluted over time, really. So in this webinar, we're just going to explore some new approaches and some tips that we've got in how you can move away from the 2011 rules and start to build your own new internal policies and procedures to better suit you and your firm and take advantage of the flexibility that they offer.
Thanks, Catherine. I was just looking, I can see that there are still some people joining, so they will have missed the very first bit, but we've got the recording, so we can send it on if you want to catch up on anything you've missed. So the SRA has very much pushed for a risk-based approach as part of the overhaul of the rules that came in a little more than 2 years ago now. Going back to you, Catherine, what do you think are the key risk areas that law firms need to consider when producing their internal policies and procedures? Because that's really the main focus, isn't it?
Yeah, so the underlying principle is that the rules are there to protect client money and to protect consumers. So that always needs to be at the forefront of your mind. There's no point introducing rules or timeframes just for the sake of it. They need to be there for a reason, and that's to safeguard client money. So the key risk factors that we consider are cybercrime is probably the top one. So that's an ever increasing and constant risk. When we say cybercrime, we're talking about serious organised crime, and fraudsters are constantly coming up with new ways to defraud us, and the way that they do that is constantly evolving. So particularly with COVID as well and people working from home, the cybercrime threat probably increased because there could have potentially been a breakdown in controls if people were having to communicate more on the phone or email rather than face to face. Yeah, so cybercrime is probably the top risk. There's some areas of law that are just inherently higher risk. For example, probate or conveyancing, we always consider to be higher risk. With conveyancing, for example, you're generally dealing with very large client money balances, dealing with various different banks, stress from a client who's desperate to complete on their dream home, time pressures, that sort of thing. So yeah, that just increases the inherent risk with that type of work. So you probably need to have a greater level of control and really strong policies and procedures in place if you're dealing with that type of work. The next risk is the financial health of the business and financial management. So if your law firm is struggling financially, there's the potential temptation to dip into client funds. From a reporting accountant's perspective, that's a definite red flag to us. There's obviously always the intention of repaying money immediately before anyone notices, but that can quickly spiral out of control. And from a law firm's point of view, if you are struggling financially, then that just takes your focus away from safeguarding the client money in order to run the business instead. The next risk I was going to touch on is money laundering. So the use of the client bank account to clean dirty money. That's where client onboarding checks are essential, and additional procedures to identify the source of funds and help spot any unusual or round sum receipts or payments is really important. Another risk that we see from the work that we do is a sort of familiarity threat with the client. So I think Claire's going to touch on a few examples later on when she shares some of the horror stories, but what we're talking about here is the risk of breaching the banking facility rules, which we know that SRA takes extremely seriously. So what we're talking about here is if you've got a really long-standing client and you're trying to do everything you can to be helpful, but the underlying legal role becomes a bit blurred, and the client asks you to make a payment which is actually more for convenience rather than relating to the underlying legal transaction, which again could be a red flag of money laundering. Yeah, basically under no circumstances can a lawyer pay costs for a client for convenience. For example, if a client lives abroad as well, like nowadays with technology, there's no reason why a lawyer needs to make a payment for someone abroad if it doesn't relate to the underlying legal issue. The next risk is just poor understanding of the rules or a lack of training. So client money can inadvertently be put at risk just purely due to a lack of training or understanding by both fee earners and support staff. So that's why it's really fundamental that you take a sensible, practical approach and put in procedures to safeguard client money, as opposed to a long list of prescriptive rules that might seem pointless in the context of the overall aim of actually safeguarding client money. So another thing that we definitely recommend is putting in place an internal training day for all fee earners and support staff. That's something that we've actually seen if you do get investigated by the SRA, being able to prove that you've had a training day or you provide constant training to your staff can be really important. The final risk I was just going to talk about is just poor record keeping and a lack of control. So for example, if you haven't got the appropriate kind of segregation of duties in place, or dual authorizations, for example, for bank payments, review procedures. Just to give an example, so simply asking the COFA to blindly sign the bank reconciliation isn't really good enough. The COFA must fully understand what the bank reconciliation is, how it's performed, what it's trying to achieve. You'd expect the COFA to be raising queries when they look at the bank rec, rather than just signing it off when there's unreconciled items. Any unreconciled items should be looked into and investigated. So I think that was it really in terms of the risks I was going to talk through.
Okay, lovely, thank you. And then we'll move on to Harriet. Catherine's given, by the way, I should mention that Catherine and Harriet have had an IT problem this morning, barely 5 minutes before this started. So they're sharing a screen, they're huddled together and sharing a screen. So I don't think you can see, but I can see that they're just shifting position to try and get the screen in the right place. It's sod's law that IT works brilliantly until you really need it, and then it breaks down. So Harriet, I can see that you're in position now. Can you just talk a little bit about where we see firms trip up, if you like? Are there particular problem areas or common breaches that we see from the work that we perform over the last couple of years since the new rules have come in?
Yeah, of course. Thanks, Claire. I mean, luckily as a firm, we don't tend to see lots of major or significant breaches, but of course we do still come across breaches. So I just want to go through the common ones that we tend to see. As Catherine mentioned earlier, using the client account as a banking facility is the major breach, and that is a really serious one that the SRA will look into. It might not necessarily be that this is the finance team working fraudulently with a client. It might just be a familiarity threat. You want to go above and beyond for your client, so you will go out of your way to help them, and that might mean paying for things on behalf of the client that shouldn't be coming out of the client account. So there's a few things that you can do to reduce the risk of this happening. Client money transactions must relate to proper instructions regarding a transaction. So a client must have given you reason for this money to come out of the client account, and as a law firm, there must be a reason that you are paying this from the client account rather than the client paying for this out of their own personal account or their own business account. This must be in delivery with an underlying regulated service. And as mentioned, your client's routine outgoings cannot be paid for by the firm. For example, if for the client's convenience, or if the client is based abroad, there's no reason that they can't use their own online banking. So there's no reason for that to be coming out of the client account. As a firm, you should constantly question why you're being asked to make these payments. Why can the client not do it themselves? There's a risk that you may also be assisting with money laundering, so you need to be aware the underlying reason for the transaction and where the money's coming from in the first place. Another indicator of using the client account as a banking facility could be transfers between different matters of the same client. Is there a reason why that can't stay in the account of one of the matters and has to be moved to the other matter? And again, that could be an indication of money laundering as well. And as mentioned, long-standing clients, the familiarity threat is more of an issue when you know the client well, when you've built up a good relationship with the client, and things may slip. You may trust the client too much, and it's not necessarily a bad thing having a good relationship with your client, but you still need to maintain a professional distance with them and keep questioning where these transactions are coming from and why they're happening. Retaining client monies on account for potential future work as well. Now that could put the client account at risk of banking facility, because why is the money there? Why is the money in the client account? Why has that not been returned to the client? And it is actually a breach of the rules to keep money on client account that should be returned to the client. At the end of a matter, as a firm, you need to be assessing, is there going to be any more future work for this client, or should we be returning this money to the client? The rules don't anymore. The 2019 rules don't specify how long the client money should be kept before being returned to the client at the end of the matter, and that's where it's important that your own personal, the firm's policies and procedures specify how quickly at the end of the matter money should be returned to the client. Another area that we see firms tripping up is in relation to bank reconciliations. The SRA have actually said that the majority of qualified reports that they receive contain issues arising from client account reconciliations. And during lockdown, this is where we probably saw the biggest increase in breaches. As Catherine mentioned, now the rules state that the bank reconciliations don't just have to be reviewed by a COFR every 5 weeks. They actually need to be signed, or evidence of a review needs to be documented. And obviously, as we were working from home, that became slightly more difficult. But as long as there is a review process in place, and again, this is implemented into your own internal controls, then this is fine, as long as we can see evidence of this happening, be that an email chain, or obviously a physical signature is ideal, but not always can happen if we're all working from home. To ensure compliance with the rules and to ensure client money is appropriately recorded, it's recommended that firms produce three-way reconciliations. So what this means is agreeing the client bank statement with the client matter listing with the internal accounting records. There may be differences between any of these numbers, but it's obviously important to look into where these differences have come from and reconcile these balances. When reviewing the reconciliations, a way of something to look out for to reduce the risk of these reconciling balances going unnoticed. Look out for old outstanding checks or payments. Why have these not been processed? If you sent a check to a client or a check to a third party a year ago, a year and a half ago, why have these not been banked? Do these need to be cancelled and resent in another way? Are any client ledgers overdrawn? Has too much money been taken out of a client ledger? And is that an indication that client money is being used, not necessarily fraudulently, but incorrectly? Is client money being safeguarded? Are there any items which appear to be used to balance the reconciliation? When looking on the bank reconciliation, can we see anything that says error or difference £2,000? That might be an indication that someone's putting that balancing figure in there to correct the balance and try and make sure an unrecorded payment or a fraudulent payment is covered up, I suppose, when the COF is reviewing the bank reconciliation. And finally, have all client bank accounts been included, including the client's own account? As Catherine mentioned, the new rules state that the client own accounts now need to be included in the bank reconciliations. So we need to be sure that all client accounts are being reviewed and that the monies in all of the accounts are being safeguarded. And also, although the rules don't specify this, it's also a good idea to perform bank reconciliations on the business account. We need to be aware of money that's going through that could be client money. There could be client money that's been deposited to the business account incorrectly. So it's a good idea to make sure you're aware as a business whether there's any reconciling items on the business account as well. if the coffer at your firm isn't a finance professional, there's a chance that they might not have a complete understanding of how the bank reconciliations work, or what's included in them. So it's important as a finance team that you sit down regularly with your coffer, explain where the reconciling items have come from, what as a team you're doing to ensure that client money is safe, and just make sure that when they're reviewing they actually understand these reconciliations, because at the end of the day it's their responsibility to review these at least every 5 weeks, so they need to be sure that they're understanding them. And also, as was the case previously, many of the breaches we see are in relation to what we used to refer to as the 14-day rule. This rule states that all receipts must be allocated promptly between the client account and the business account. The rules don't specify what promptly means, so as a firm you need to be making sure that your policies and procedures specify what this means, how quickly monies are going to be transferred between the client account and the business account when it becomes business money. One way in which to reduce the chance of this breach occurring is to ensure fee invoices are sent out to clients as soon as, or as quickly as they possibly can be, as soon as they're raised really. This helps the finance team keep track of any amounts that can be transferred from the client account to the business account, and hopefully reduces the risk of them going unnoticed too long. In addition to this, coffers should regularly be spot checking matters. I mean, this is part of their review process and part of their role as a coffer anyway. But hopefully this will give them a chance to get another set of eyes on the matters, I suppose, and they'll hopefully spot matters that maybe if the finance team are becoming too familiar with them, maybe would go unnoticed. Things to look out for when reviewing matters on files are, as mentioned, are any client accounts overdrawn? It likely means that money has incorrectly been moved from that client's account. Maybe it relates to another client matter, and that needs to be rectified quickly. Or have there been a larger number of transfers between clients or matters? This could be because of a previous error or fraudulent transactions maybe are trying to be covered up. And also, is the breaches log being regularly updated? None of us are perfect. There's going to be breaches throughout the year, and the finance team need to be making sure that all the breaches that are identified are recorded, and the coffer needs to be reviewing these breaches and this breaches log and ensuring that policies or things are being put in place to reduce the risk of these breaches happening again, and to understand how these breaches have occurred, and why they've occurred, I suppose. And finally, are there any matters that could be closed? Having too many matters will make it more difficult to identify breaches on other matters. So if you reduce the number of matters, if there are matters that are open that funds could be returned to the client, these matters don't need to be open anymore, then we recommend closing these to make it easier to review the clients and the matters that are in place. I think Claire is now going to discuss some experiences we've had in the past with breaches of the rules.
Yes, we're at the sort of middle section, so we're just going to go through a few, well, I've called them horror stories, just to frighten you all really, but then we'll move on to tips and practical suggestions for how you can make better use of the flexibility that the 2019 rules now give you. So before I launch into these horror stories, let me just reiterate the fact that, you know, it's very rare for us to see fraud in any of the law firms that we look after. I mean, we've seen it a handful of times, you know, out and out fraud. We know that the clients that we look after and the vast majority of law firms are doing everything absolutely above board. But the difficulty is that you've got a lot of rules and a lot of money to look after, and you're under pressure from clients. And so a lot of the breaches that happen are just, you know, admin errors that you wouldn't have intended to happen, but they did anyway. It's not fraud. So just going back over some breaches that we saw under the old rules, I think I shall forever remember in my career many years ago. So this was, it must have been the 2011 rules. I think it can't have been the 1998 rules. But in the 2011 rules, we had a small firm of solicitors where the list of breaches that was reported to the SRA ran to 13 pages. And there was about £8 million worth of client money that just couldn't be tied down to a particular matter. And it really arose because the solicitors were using a bank, I won't say which bank, but it was using a bank's own software, client accounting software. And I'm sure the software probably worked if you used it correctly, but in this case it wasn't being used correctly. And so and it probably wasn't flexible enough either, compared to the some of the good software packages that are out there. And it meant that the solicitors just couldn't keep track of the money, and they also didn't place enough importance on keeping track of the money and knowing which matter the money related to. So for several years, actually, we filed this report with the SRA with about 13 pages of breaches and making it very clear that there was 8 million that couldn't be traced to a particular client. We didn't think it was fraud. We found no evidence of that. We thought it was just that the law firm wasn't paying enough attention to the money. To the underlying bookkeeping records. The SRA did nothing for many, many years, and then eventually there was a complaint from a client of the solicitors of the law firm, and that seemed to sort of jerk the SRA into action. And very quickly they came swooping in and closed down the firm, and they put in another firm of solicitors to take over the clients, and there was a fine imposed on the solicitors who had been running the firm. So it was, it was a circumstance that I've not seen to that extent again, thank goodness. But it just shows, if you don't keep on top of things, how bad things can get. Another one which was actually fraud, this one, was a small firm where one of the partners discovered that one of their fellow partners had dipped into client funds because they'd made a personal financial investment that had gone wrong, and they were just trying to cover their own tracks, basically, and they dipped into the client account. A very sad situation, resulting in somebody being struck off. But fortunately, we don't see that kind of thing very often. So what we do see occasionally is a lack of attention to anti-money laundering and the conflict with anti-money laundering checks. So we had one, again, this is a few years ago, so this strictly isn't under the 2019 rules, but the ones after this will be under those rules, where a client was looking after what I'll refer to as a foreign diplomat, somebody who was coming into the country, wanted to buy some properties, and they said to one of the solicitors in this firm, look, when I come over to the UK, I don't really like using taxis and public transport. I want to have a car while I'm over here, but I want to actually buy one. Can I send you some money, and then can you just get a car for me, basically, and then I can use it while I'm over here and while I'm buying all these different properties. And the engagement with the solicitor was to buy the properties, nothing to do with a car. So the solicitors bought this car, and the person came over and supposedly used the car, and then I think some properties were purchased, which was the original intention. And then the person went back to the country they came from, and there was a message given to the solicitor saying, well, I couldn't really take the car back home with me, so would you mind putting it back into selling it for me and just paying the money into this bank account? And it was just money laundering, plain and simple. And of course, you have a duty not to tip anybody off that you think you've discovered money laundering. But I think the solicitors did very quickly come to the conclusion that, oops, we haven't really focused on this very well, and that's what we've let happen. Now, breaches that we've seen that have happened under the 2019 rules, we had one where, and it was a cybercrime point. Catherine's mentioned cybercrime a couple of times, and it really is important, and it's not really very well covered in the 2019 rules. But we had a firm where they had a call from the bank, only it wasn't really the bank, saying, we can see that you've tried to transfer this money, it hasn't quite worked, could you just press this button and give us this code, and then we'll make sure that the transfer happens. So the finance person at the law firm realised, well, this could be dodgy, so they rang the bank manager, the actual bank manager, and said, look, I've just had this call, does it sound okay to you? And the bank manager said, yep, that sounds fine, go ahead. So the transfer was made. But what the finance person at the law firm didn't realise is that the bank manager was actually in the pub at the time and hadn't really been focusing very intently on the conversation, excuse me, and should have said, well, hang on a minute, let me get back to the office and then look into this properly. So basically they transferred over several £100,000 worth of money into the fraudster's hands. The bank accepted liability, so the law firm wasn't out of pocket. But it just shows that even when you as the law firm think you're doing the right thing and phoning the bank to check that it's right to do the right thing, it's right to make a transfer, sometimes it can still go wrong. Another one which does make me laugh, and I won't name the bank that was involved, but a client of ours said, the finance director rang me up and said, I just want to let you know that we had a fraud attempt. I had a phone call from somebody who said they were from our bank, wanting me to transfer some funds. He said, Claire, I knew it wasn't our bank because they sounded far too professional. So the transfer wasn't made, and they were all safe. Then there are, actually we've had questions on this as well. There's a breach, potential breach that we see quite often is when you're trying to repay a client by cheque, but the client simply won't bank the cheque. The rules aren't explicit as to what you should do in this case, but actually what the rules want you to do is keep trying to get the client to bank the cheque. So you're going to have to cancel the cheque and reissue the cheque. Consider different ways that you can pay the money back to the client. And ultimately, you've got to document why that client won't pay in the cheque. In this particular case, and this was only one that I saw a few weeks ago, the reason that the client wouldn't bank the cheque was because they were unhappy with the settlement that the law firm had negotiated for them, which was the transaction that the law firm was doing. So they didn't want to bank the cheque because they just thought they were entitled to more. So there was actually a reason for not banking it, but that wasn't documented, and we didn't get to the bottom of it until we really inquired into it. So yes, you do have to, I'm afraid, keep documenting if clients won't pay in cheques, and think of other reasons that you can get the money across to them. Other breaches, which are less horrific, but they are very common, are, and I think Harriet's touched on one of these, the SRA paid a visit to one of our clients and said to the coffer, who wasn't a finance person, they were a partner rather than an accountant, but they did have the coffer role. The SRA said to them, so can you talk me through how you reviewed this bank reconciliation, which had been prepared by the finance person? And the coffer really didn't know how to talk the SRA person through it, so it became obvious that they didn't therefore know what they were reviewing. So just make sure that you do understand what you're looking at, which is what Harriet's just said, and raise questions with the person who's put the bank reconciliation together. Another one, which again Harriet's touched on, is the familiarity problem. So this does play into the banking rule, that if quite often we try and go above and beyond with our clients, we try and do everything we can to, you know, give them a good service, to go above and beyond to really help them, but sometimes that means that you're falling into the trap of letting your client account be used as a banking facility. And we do see this happen on a number of occasions with clients where there is an underlying transaction, but once that's finished, the client continues to say, well, could you just pay this for me, or could you just transfer this money instead of paying it back to me, transfer it into this company because I'm just about to do something with them and I might appoint you to help us with it or something. And it's, you know, it's not allowed. When the transaction is over, you have to return the money to the client unless there's a very good reason not to, and that reason needs to be documented. So we do see that a fair amount of times, and I think in a lot of cases it's where the partner concerned or the fee earner concerned has been at the firm for a very long time and nobody really feels that they want to question that partner. And of course it's the coffer's role to spot check some of these files and to raise those questions and to ask, even of partners who've been there for a long time and you know, don't really want to have to answer questions, they need to be looking into their files and making sure that they are still adhering to the rules. So we're going to move into the section now where we're talking about practical tips and takeaways, and this is really from where we've reviewed files and we think, well, why doesn't this law firm change their policies and procedures so it says this, because it will help them out, it will suit their particular circumstances much better. And in most cases it's because they've been basically adopting the 2011 rules and they don't quite fit the firm, and there is scope to be a bit more flexible. So in a second I'll hand over to Catherine and Harriet to talk about the operational level tips, but I just wanted to start with a sort of strategic level tip, which is, don't forget, if it ever is forgotten really, that the whole principle is that you step back and consider what the new rules are asking you to do, which is keep the client money safe. And now you're able to keep the client money safe without having to comply with a great long list of prescribed rules. So just as firms set out their core values, for example, which all staff and partners will adhere to, they ought to also set out their key principles for keeping client money safe. And rather than taking the 2011 rules as your starting point and adapting them, start afresh and build a completely new set of rules and principles, which incidentally, when we see new law firms set up, that's what they will do, because they will completely start from scratch. It might seem like a daunting task, but it'll ease the burden in the long run. The new approach should be based around your workflow with guidance for each of the steps involved in the process. And all in all, the new policies and procedures should be about how you choose to run your business. If you're running your business effectively with good controls in place, as you all are, the risk to client money will already be very low. And establishing really clear policies that are adapted to fit your particular business will reduce that risk even more. So at a strategic level, that's really what it's all about. At an operational level, we're talking about documenting your own systems and looking what's reasonable for your particular firm. And at this point, I'm going to hand over to Harriet, who's just going to talk us through some very practical things in the last sort of 15 minutes or so, things that you can think about that you might want to just tweak your policies and procedures for.
Okay, thanks, Claire. I suppose, as Claire mentions, there's a lot of flexibility now with the 2019 rules, and each firm's different, so you need to be applying them how they suit you really, and how they suit your team. For example, if your finance manager or your bookkeeper only works 1 day a week, rectifying an incorrect posting the next day or the same day isn't necessarily going to be, it's not going to be maintainable in your firm. So you could update your rules to say what you think promptly means. Are these going to be rectified the next time the finance manager is in the office? Suppose you could say the next working day. That gives a bit more time. If a breach or if an issue happens on a Friday, that doesn't necessarily have to be rectified on the Saturday. But the important point is to document these considerations in your policies and procedures. Make sure you have said which rule these apply to, and what you recognise promptly to mean, and how you're applying that to your firm. The finance manager also needs to make sure they're documenting their actions and what they're doing to rectify these breaches, and what they're going to do in the future to reduce the chances of them happening again. Money can also be transferred to office account now once a bill has been raised and sent to a client. We often find that bills are raised but then don't actually get sent to clients, and this can cause issues between the fee earners and the finance managers, I suppose. If your rules and if your policies and procedures state that the money will be transferred within, say, 14 days of the bill being sent to the client, this gives you a bit more of a time frame and gives you a bit more of a chance. However, sometimes these bills can be sat on for a few days, or even sometimes a few weeks, and the finance manager or the finance team won't necessarily know that these bills have been sent. So it might be worth updating your policies and procedures to say fee invoices will be sent to clients within 5 days of the fee being raised. And as mentioned earlier, some firms like the flexibility, but it's not always easy for the COF and the finance team to implement these rules with the fee earners and with the staff. So if these stricter rules are in place and it says exactly how quickly the fees need to be sent to the client, this will hopefully reduce the chance of these breaches occurring. I think, as Catherine mentioned earlier, the guidance for Rule 2 now talks about how it's okay to transfer funds from client to business account for disbursements that have not yet been incurred, as long as the bill has been raised. This isn't something we generally see firms including in their policies, and I suppose it's probably because it's slightly new with the 2019 rules. A sensible policy could be client money can be transferred to the business account for disbursements that haven't yet been paid, so long as the bill has been raised first, and that this can be raised within this can be transferred within 14 days, within 10 days, within 20 days, whatever suits your finance team. This flexibility also aids cash flow. It means the business can transfer money from the client account quicker, and then the money is available for the business as well. If as a firm you're following the 2011 rules, this will prohibit the firm from transferring this money until the disbursement is incurred. So, as I mentioned, it gives a bit more cash flow flexibility there. Also, and it's something we're seeing less and less with firms, but the use of cheques. As mentioned in the bank reconciliations, cheques aren't aren't banked as promptly as just a BACS transfer. And this can cause issues with the bank reconciliations. It can cause client accounts to potentially go overdrawn if it appears the cheque might have been lost in the post. Maybe 2 cheques are sent and then the client banks both of them. That will cause the client accounts to become overdrawn. How are you going to get this money back as well, which could be an issue. A lot of firms are moving away from cheques and moving more into online banking. It makes it easier to, I suppose, keep track of the transactions. There's more of a review process in place. You can implement dual authentication, sorry. So that will hopefully protect client money more. And it should also reduce the burden around closing client matters, because as soon as the money is transferred out the client account on the online banking, the money's not going to be there. There's not going to be a delay, and you know that on that day you can close down the client account. And I think one thing the pandemic has opened our eyes to is using electronic versions more, moving away from paper-based. So if the COFA or if the finance manager needs to review a pack, if they need to review a transaction going through a bank transaction or the bank reconciliations, consider sending them an electronic version. They don't necessarily need to print out pages and pages, review these, add a physical signature. A physical signature is obviously great, but could they add an electronic signature on the PDF? Could they send an email, say, yes, approved, I've reviewed this, I reviewed this on this day, or I have these questions. What does this payment mean? What does this payment relate to? And I suppose it makes the process a bit quicker. There's less of a chance of the reviews not taking place every 5 weeks if the COFA goes on holiday, say, if for whatever reason they're not in the office. If they have an email to hand, they can review it there and then, and there's less of a chance of breaching the rules there. And and also slips for transferring money from the client account. In the past, we'd see reams and reams, boxes and boxes of paper slips for transactions going from the client account, fee earners or coffers approving the payment, using the dual authentication on the bank account, on the online banking. That can reduce the paperwork as well, which is obviously environmentally friendly, and also makes the process quicker. They can just sit through, review, go through quickly, and hopefully, like I say, reduces the chance of the breaches occurring.
Thanks, Harriet. I think maybe you covered it. I think you were going to cover a point on using DocuSign for signing bank recs, or did you cover that? Was I asleep?
Yeah, I suppose I mentioned adding an electronic signature.
Right.
Yeah, and yeah, whether you use Adobe DocuSign or if you've got another program in place to add that, then that's something that you can. It has a physical signature to show that it's been reviewed, but you don't actually have to print all the documents out.
Yeah, I think that's a very good point. I was talking to a client during the pandemic, during one of the worst parts of the pandemic when, everybody was working from home and couldn't leave the house. And we were doing their Solicitors Accounts Rules Accountants report and noticed that the solicitors weren't really approving the payments from client accounts. So we said, you still got to do this. You can't just leave it up to the finance person in this particular situation to take money out of client account. And one of the solicitors says, oh, we're still approving it. I've got all the slips. And I said, well, how are you able to do slips and how are you getting them to the fee earner? And they said, well, I sign the slip and then I scan it in and send it to the fee earner. And so we I think they were in just a state of confusion, with everything that was going on with the pandemic. But, I just remember saying to them, you can use email. You don't have to go back to this very archaic way of producing a piece of paper and then having to scan that in. You can do things by email. You've just got to provide some kind of audit trail. So the DocuSign for things is a really useful way of covering that off. Catherine, can we just pass over to you just for the last few minutes, just to talk about anything else that other tips that you can give, or things that aren't explicitly covered in the 2019 rules, maybe?
Yeah, sure. So I guess this isn't specific to the 2019 rules, but I think we've mentioned a few times now how cybercrime, from our point of view, really we think is the biggest threat to client money. And having now done some of our accountants reports under the the 2019 rules, I don't think any of the policies and procedures that we've looked at specifically refer to cybercrime. So we would definitely recommend drafting guidance for all staff members relating to cybercrime and ensuring that there's regular training provided, and any sort of examples that you might read about, they're communicated to staff members that have any kind of role within online banking, within making payments. Basically train your staff to be skeptical and questioning. Don't ever trust anyone on the phone that might ask you to make a payment. I'm sure that's something you're probably already aware of, but it's just that constant message to staff members. Stay in touch with your bank as well, see what advice or assistance they're able to provide with regards to cybercrime. But yeah, we really think that cybercrime is the biggest threat to your client money, so it's just something that really should be thought about within your policies and procedures. Another kind of tip, I suppose, is where possible, make use of any electronic reports that you're able to run. Obviously, this would be dependent upon the capabilities of your specific software that you're using, but technology is getting better and better, and any report that you can run that might detail, for example, client-to-client transfers, or a report that you might be able to run to show any matters where there's a client balance held but there's been no activity for, say, 6 months or something like that. A report like that might be useful to help you close down any client matters that have finished but the money hasn't been returned to a client. So just think about where you might be able to use technology or use an electronic report or something from your software to try and help you safeguard and manage client money as well. The next point I was going to mention is just kind of the trade-off between the use of suspense accounts and contravening AML guidance. So back with the 2011 rules, the SRA really pushed for you to use suspense ledgers when money came in from a client but you didn't know which client it related to. Obviously, it's explicitly said in the rules that suspense accounts should be used on a temporary basis only. The 2019 rules, they don't mention suspense accounts at all, and the focus really is more on ensuring that you have a policy in place for that scenario where money comes in from a client but you don't know who it relates to. So yes, so you should document in your policies what process you're going to put in place. So what was I going to say? So, for example, sensible steps might be to keep a record of contacts that you've made with the bank to try and investigate the receipt and any attempts that you've made to identify the money or return it to clients. Maintain a separate list of unidentified money and review that weekly or monthly. The same basis still applies, that you want that money to be unidentified for the shortest amount of time possible. So you need to do whatever you can to try and identify the money. But yeah, there used to be that kind of trade-off between contravening the AML regulations and the use of suspense accounts. So that's kind of been taken away because you're not encouraged to use suspense accounts in the same way, but you still need to make sure that you're monitoring that money and trying to identify who it belongs to. Just another point to consider. So in the future or near future, we think that interest rates are likely to go up at some point. Historically, back in the day, a lot of law firms used to make a sort of fairly sizable amount of money from interest on their client accounts. In the 2019 rules, they state that you must account to clients for a fair sum of interest on client money. However, you may, by written agreement, come to a different arrangement as long as you provide sufficient information to enable the client to give informed consent. So basically, it's really up to you how you're going to account for interest on client monies. But if interest rates are going to go up and you want to sort of take advantage of that, then now's the time to put the system in place to allow you to take advantage of that. Obviously, there's a bit of an ethical kind of trade-off there. So some people might not believe in keeping the interest on the client account for the firm. But basically what we're trying to say is, with interest rates likely to go up, now's the time to think about how you want to approach that and how you're going to document your interest policy to clients. The final point I was just going to make was just about third-party managed accounts. So obviously that option is there from our client base, we don't have any clients that use third-party managed accounts, and also from what we've read and the sort of statistics that have been provided by the SRA, the use of them is very limited still. The feedback seems to be that firms are reluctant to go down that route, sort of citing potential time delays and cost implications outweighing any potential benefit of using third-party managed accounts. But just a reminder that they are there, that is an option now, and it's just something to think about.
Catherine, thank you. That's great. We're almost at the end at time now, so I was just having a look. We had questions, and we had questions before actually. I'm just going to cover off one quickly, which is, I think this has come from a finance person. How can I get the fee earners to follow the rules? Well, yes, I mean, we do sympathise. I mean, the fee earners are terribly busy. You as finance managers are terribly busy as well. But of course, you're the ones as finance managers and coffers who have to make sure that the bookkeeping is kept up to date, and that's a bit of a problem if you're not getting the information through from the fee earners. Perhaps in light of what Harriet and Catherine have said, and the overarching message being, if your written policies and procedures at the moment say we are largely following the 2011 rules, perhaps with a few tweaks here and there, perhaps have a rethink about that and revamp those policies and procedures so they actually don't mention the 2011 rules. Have a little bit of a look through them and bring them more up to date, and then you can circulate that to fee earners and say, look, we've updated this. The 2019 rules have been in for a full 2 years now. I just draw your attention to X, Y, and Z, and that might act as a bit of a reminder for fee earners. It might help. The other thing is regular training. I mean, we do see that when the SRA inquire into things, that if you can prove that you've given everybody regular training, it does mitigate any sanctions or any, that the SRA being annoyed that the firm hasn't quite complied with something. So hopefully you've taken away some pointers from today's session on how you might be able to change things and make things a bit more flexible for your firms. We're always very happy to look through policies and procedures, whether you're a client of ours or not. If you just want somebody to have a separate independent review, then please let us know. We'd be very happy to. As we said, we will circulate details of our next webinar, which will be in March. We'll send that through to you. If you'd like a copy of the recording of this one, let us know. It takes a few days for us to put it together, I think, and just edit it and things like that. I think the download time, apart from anything else, takes a little while, but we will send that on to you. And thank you to Catherine and Harriet, and also to Chloe and Joseph in the background who've been masterminding the production. Thank you everyone in the audience for coming today and for submitting questions and things throughout. It's been very helpful, and we'll see you next time. Bye bye.